Operating procedures of monetary policy. So in this session, we'll go through the basics of operating policies. We'll also go through liquidity adjustment facility, monetary policy corridor. We will also see what is operating target, monetary transmission, and channels. So first, we'll go through the basics of operating policy. So in this lesson, we have already told that we'll be going through operational target, money market operations, corridor, signaling policy intentions, etc. So in this lesson, day-to-day management of monetary conditions that make up the overall caliber of monetary policy is called the operating procedures of monetary policy, and that is what is discussed. Generally, the operating procedures of monetary policy involve an operational target, whereby a particular operational target is chosen in order to achieve that target or work around it. For that purpose, the central bank plans different money market operations in a way that is distinct in its nature, extent, and frequency. To calibrate short-term market rates, a corridor is used and a specific width is recommended. And it also involves a specific way of signaling policy intentions. Now let us explain what are operating procedures of monetary policy in India. First, it is liquidity adjustment facility. So this is recommended by Narasimhan Committee, and a liquidity adjustment facility is a tool of the monetary policy, primarily from RBI, that allows a bank to borrow money at repo rate or repurchase rate from RBI and to lend money or make a loan to the RBI using reverse repo arrangements. So that is what is LAF. So LAF is liquidity adjustment facility, and we have already explained it's a tool of monetary policy. And it allows a bank to borrow money at repo rate and lend money or make a loan at reverse repo rate. Now, liquidity adjustment facility, by increasing or decreasing the money supply, can manage inflation in the economy. So that is what is LAF, and now how it works. Various banks uses securities as collateral by making a repo arrangement and uses the cash, which is a loan given to the bank by RBI, for the short-term requirements and to remain stable in the market. The transaction of liquidity adjustment facility takes place at a particular time in a day, generally twice a day. Also, an entity who has shortfalls in cash engages in repo agreements, and an entity who has excess cash engages in reverse repo agreements. So that is how it works. Now, whenever the RBI reduces repo rate, the bank borrows, which would mean that there will be excess of cash in the system, prompting the bank to lend money to the borrowers. This in turn would increase economic activity in the system. Overnight, when the bank agrees to buy back the securities from RBI by offering a loan, it does set reverse repo rate, which also stands reduced whenever there is any such move by the country's central bank. So that is a gist of how it works. Now let us see what is policy rate. So for policy rate in a surplus condition, the reverse repo rate becomes the operating policy rate, and in a deficit liquidity situation, the repo rate becomes the policy rate, though in international best practices, it is highly unlikely to have two policy rates. Next is what is bank rate. Bank rate was used as an instrument of monetary control until liquidity adjustment facility or LAF system was instituted by the RBI, and progressively facilitates for refinance were provided at repo rate. Nowadays, bank rate is used as a penalty whenever there is a default in CRR and SLR, which is cash reserve ratio and statutory liquidity ratio, which we will tell what it is, as required by RBI and Banking Regulations Act. So that completes liquidity adjustment facility. Now let us see what is Monetary Policy Corridor or MPC. This is one of the instruments that RBI has introduced in its monetary policy toolkit, where it indicates an area between two rates of RBI's monetary policy, which at the lowest level is reverse repo rate, and at ceiling or at the highest level, it is marginal standing facility or MPF. So this is a corridor between reverse repo rate and marginal standing facility. Now, before gauging the width of the corridor, we will say what the reverse repo rate will be the lowest of the policy and MSF will be the ceiling or the highest rate more than repo rate. Repo rate will be in between reverse repo rate and MSF rate. Now, the reverse repo rate and the MSF determines the corridor in the weighted average call money rate for all the daily movements. So now how would the width of the corridor be gauged? So in the recent episode of liquidity tightness, the RBI has been providing additional liquidity up to 2% of net demand and time liabilities at repo rate, mostly on an ad hoc basis. Also remember that net demand and time liability are in a sense all liabilities which are payable by the bank on demand. Now the advantage exists because it provides an upper bound to the policy rate corridor. It also provides a safety valve against which an unprecedented against all the unprecedented liquidity shocks. So in a liquidity deficit situation, it will help stabilize overnight interest rate around repo, and it will enhance the liquidity attribute of the SLR portfolio. Now, what is SLR? This is statutory liquidity ratio. Is the minimum percentage of deposits that a commercial bank maintain in liquid cash, gold, or other security. So it's a reserve requirement that banks are expected to keep them before ordering credit to customers. Now the width of the corridor, how it can be gauged. The width of the corridor should be in such a manner that it should be narrow enough to induce volatility in short-term money market rates, and it should be wide enough so that it does not stunt the development of short-term money market, especially by taking away the incentive from market participants so that they deal amongst themselves before approaching the central bank. So that should be how the width of the corridor be gauged. Next, we'll take a look at the operating target. The operating target of the monetary policy is the overnight call money rate, as the monetary transmission in this segment is the fastest. However, it is noticed that in the past few years, the turnover in the uncollateralized segment has reduced sharply in the interbank money market segment. But the turnover has increased in collateralized borrowing and lending, obligations, and market repo. This may seem to suggest that the prudential limits prescribed by RBI have not constrained the growth of call money market. Rather, it increased the money market and its stability with an increased share of the collateralized segment. So before we let you go, it's equally important that we see the significance of monetary transmission. In other words, operating procedures pay special attention to monetary transmissions and policy rate or rate of interest. This is what we explain next. So in operating target, we explained whether it's the overnight call money rate. Prudential limit we explained. So and next is monetary transmissions and channels. So here it's transmissions through financial prices and financial quantities. So monetary policy actions through changes in financial prices and financial quantities and transmitted to the rest of the economy. So what are financial prices? Financial prices are mostly interest rates, exchange rates, and yields, along with equity prices and asset prices. And what are financial quantities? Which are essentially foreign denominated assets, government bonds, money supply, and credit aggregates. Sometimes due to concerns in money demand function, increased attention is thrown to financial price channels. So about financial price channels and interest rate channel. So in particular, the interest rate channel emerges on the as the key channel of transmission, mostly because short-term interest rates emerge as a predominant instrument of worldwide monetary signals. Now next, we'll see how is the real interest rate returned to fundamental levels. So we know that an increase in nominal short-term interest rate gives way to higher real interest rate. This is seen to affect the investment and spending behaviors of firms as well as individuals. So for them, the disposable income is reduced and the current consumption from the perspective of market is reduced. However, the savings behavior gathers momentum and more people starts to save in the society. Also, the higher interest rate is seen to diminish the profits of the firm. This in turn would signal that new investments are less attractive. In other words, consumption and investment reduces, which typically would shrink the output. This pulls the price of goods downwards. So as the price of goods and wages adjust in the long run, real GDP will be at a potential level where real interest rate and real exchange rate return to their fundamental levels. So this completes monetary transmissions and channels, and we have actually come to the conclusion of operating procedures of monetary policy in India, where we actually have seen all the operating procedures of monetary policy, which is an operational target, money market operations, how calibration of short-term market rates are done, and it also has explained a special way of signaling of policy intentions. Thank you.